Nirmal Jain, the founder promoter of the company, is here with us. In fact, the reason is that he has been a market participant and has a demonstrated track record of value creation for previously for other companies as well. Nirmal, it's so nice to have you today. And today we will not talk about markets. We will talk about the company which is taking all your mind share right now as out of the other group companies. This one I know that you are really very hands-on right now, and it is demonstrated in numbers as well. The market cap is over 11,000 crore now, and as well your loan book of IIFL Finance has crossed 50,000 crore. Tell us how things stand, and strategically you with your team, what direction are you taking this company and building it from here on?
So last 2-3 years, we have been focusing only on retail. So we are creating our moat in retail because we are an NBFC with probably the largest network of its kind, and we have got almost about 3,000 branches all over the country, and which over the last 1.5 decades we have built organically, and they are all meant by our own employees and people. So IIFL Finance Group, we employ almost about 29,000 people, which is a fairly large number, but the focus here is that we source all our loans from our own people rather than relying, as many other NBFCs, they source bulk of their loans from a DSA network. So that is one key thing, but when you source loans from your own people, advantage that you have much superior control over the credit quality, and you have much better control over collection efficiency as well. And we have been focusing on digital technology a lot. So our strategy is phygital, that on one hand we have a physical network of branches, and on the other hand we want to be pioneer and we want to be innovative approach to technology. So when it comes to digital technology, we realize that all innovations can't be done in-house, and all the best-in-class technology cannot be done or developed by our own people. Although we have more than 300 people in our technology team, but still there are a lot of technology partners that we have. And what we are seeing now that government and RBI both are very keen to make sure that the credit is delivered to the underserved segments, and in particularly MSME sector. So if you look at MSME sector, then there are almost about 75 million, or maybe, so we are talking about something like, there's a large number of MSMEs, maybe 7.5 crore MSMEs that are there who are in need of credit. Despite a lot of effort by the banking sector, they does a great job, but still there's a physical limitation to which, how much they can penetrate. To understand what these MSMEs are, that 90% or more than 90% of MSMEs will have a working capital requirement of less than 50,000 rupees. So obviously that is too small a loan for a bank to go and say that we want to check your bank details or your turnover records, your sales and purchase, and most of them won't have account books also. So this is the long tail of MSME that we want to service, and they are in need of credit, and there's nobody reaching out to them to give credit. And here we have done a venture with another big fintech. That's become unicorn. It's called Open Financial. What they've done is that they have set up a neobanking, and on their own they've got 2 million MSME enterprises who are using their neobanking services. So to make it simple, when say the neobanking, so if you go to a large bank, their banking interface to open a current account, so a large bank will have probably interface where a large company like our company IIFL can open an account, or a very small chaiwala can open an account. Obviously, the interface that you need for a very small chaiwala is a very simple interface, and they don't need a complicated interface which a corporate entity will need. So what neobanks do is that they make a simple custom-made interface for opening a current account for these small MSME enterprises. Along with, they also give them certain accounting software on the cloud, or invoicing, or a payment solutions, or a reconciliation, and many other services like tax-related services. So all this can be clubbed in, and they've done a lot of work in the last 5 years, and that's how many investors like Tiger, Temasek have invested in that company in Open. So when we have partnered with them, the idea is that they provide technology and we provide the underwriting capabilities, and this happens through a joint venture. Now, I think this joint venture basically can get very large number of customers, MSME customers, The credit will be provided by IIFL Finance and technology will be provided by Open. And obviously the subscription fee is shared, and from the credit margin also, some part of fee can be given, will go to this joint venture.
Nirmal,
I
let's break
think
it
that
down a
this
little bit
is a very
for our
exciting
viewers.
opportunity for the company. Yeah.
Let's break it down, all those points a little bit. Nirmal, when you say or the management has guided for aiming to double the loan book to 1 lakh crore, how will initiatives such as the Sesame neobank also comes in handy, and where does it fit in and propel your growth exactly?
We have right now 4 engines of growth. Gold loan is one where we expanded our brand network last year very aggressively. So we'll look at now making the new branches as they scale up. We should see a significant growth higher than the market in the gold loan. Then another engine of our growth is home loan. There our focus is on affordable home loan, and our average ticket size is 15-16 lakh rupees. The third is what I talked about is MSME, where digital focus probably should drive our growth. And there we can cross-sell to our home loan and gold loan customers as well. And the fourth is microfinance, which again is nothing but MSME one level below, or the bottom level. And that also basically are the customers who can be provided new banking services by this joint venture. So these 4 products, where our focus is either on a very solid collateral, which is gold or home, where the collateral would not depreciate after you give loan, or on a businesses where we can analyze their cash flows and the loans are serviced from cash flows. So this is our focus is, and so these 4 products basically should drive the growth.
Nirmal, you're aiming to bring your cost of capital lower. On the one hand, rates in the country are going higher. You are taking initiatives. In fact, you just purchased back your $50 million worth of Singapore listed foreign bonds. Tell us how things stand, and where would you like to keep your average cost of borrowing? In what range or bracket?
So when IL&FS crisis happened, all the NBFCs were very badly hurt by the liquidity crisis. And some of them borrowed at a very high rate of interest, and their cost of fund had shot up. Even the interest costs had gone up for us at that point in time when there was kind of a crisis in the country. But thanks to initiatives of government as well as RBI and our business mix and acceptance of that by the bank, because we have been able to sell our retail loans to banks in a significant way. So, there are multiple things that have happened. One is that our requirement for loan has not gone up as much because we have been able to sell our loan assets, our retail assets to banks. And it's a true sale which goes along with the risk. So the banks basically take these assets along with the risk. So supposing there's a default, then it doesn't come back to us. That is what a true sale means. Is without any recourse to us. So those initiatives have improved our standing and our rating with the banks. Also, CRISIL has reasserted our rating at AA. They've changed the outlook from negative to stable, which also has been very positive. So these initiatives and this track record in the entire crisis, that we have not only met all our obligations, we were never desperate to borrow at any exorbitant rate, and not only that, we had enough cash or liquidity to grow our book. That now allows us to negotiate better with the lenders, and despite upward pressure in the environment or in the system, we've been able to bring down our cost of funds in the recent past.
So you are now what, 95% retail, and
we are 95% retail.
So tell us, how do you see? We are getting a sense that microfinance sector is actually taking off from here on. Talk to us. What is the potential you see on that side, that pyramid, that level of the pyramid, and about also your co-lending tie-ups you've done with 10 banks now?
Yeah, we've done with more than 10 banks. So microfinance actually is in one industry where multiple black swan events happened in last 5 years. And that's why if you see that many investors are very wary of this and they don't like this sector as such. Primarily because it was hurt very badly by demonetization. Even GST impacted this, not as much, but still. Then the COVID, the first wave, then the second wave and third wave had very bad impact on this. So most of the microfinance companies had NPAs, defaults, and restructured and moratorium and all those assets at levels never seen before. But good thing is that RBI has been very pragmatic. They realize that this sector, the risk is much more than what probably they would have anticipated. And in the credit, one thing we must understand that the credit can go to various risk assets, but the risk has to be priced in. So there's a AAA borrower, they can borrow at 6% also. But then there are whole, when you talk about the economy and the enterprises, the small enterprises, medium enterprises, there are different types of risky assets and borrowers. They also need credit, but they may not have a track record, but they all contribute to the economic growth. So now they removed the cap of 10% on the borrowing cost, what they had for microfinance, so that the microfinance companies at different point in time can vary the rate of interest. And actually, the competitive forces can bring down the rate below 10% cap also. But there may be some areas and some segments where rate can be higher. So that has been a very positive factor. Also, RBI has relaxed a number of other things for microfinance companies, including the loan amount cap or the percentage of loan that can go to non-microfinance. So these all these initiatives will really help this sector, so that this sector will be able to make sure that the pricing and the income basically takes care of the risk. So I'm very positive, because see, at bottom of the pyramid, the 67% of India's households get only 10% of credit. And that shows the potential of this. And as they grow in the economy, their income grows, their potential to borrow will be significantly more. And when they borrow, they can use this money productively for income generating activity. So I think for microfinance, one big thing that has changed is RBI's reforms and the policy initiatives which are relaxing the norms. And I think that will help the sector a lot.
Right.
And I think, so that was your first part of the question. What was the second question? Sorry.
Second,
hello?
Right. Nirmal, yes. Nirmal, clearly the business is in very good shape, and the measures which you are taking are helping in it, propelling it even further. Before I let you go, there was a good interaction about IIFL Finance and the direction it's taking. Allow me to take just one reaction from you. You have been a veteran, you built businesses, you understand business, and you also understand market very well. Allow me to take just one view from you on how the market is looking right now, the sentiment, the business sentiment, the macro worries, everything. How are things looking right now? We are in the midst of a big correction, 8-9 months. What are your thoughts, overall thought?
Okay. So, the equity markets have a character, they're volatile by nature, and globally things are not good. So let's start from global and then we come down to India. So if you look at the US economy or European economy, I mean, most analysts and most economists fear, and for good reasons, that they might get into recession. And the interest rate hike there can hurt the economy, the job market also, as well as, so there are contradictions, because right now the job market is booming. But most people fear that if the inflation is so high and the interest rate has to be hiked, then obviously growth will be impacted, corporate earnings will be impacted, and the stock market will be spooked. Now it's a very interesting scenario at this point in time. But as India is very well placed, and India is in a sweet spot for a number of reasons, So if you see, the China has been a big destination for investment capital, but now most investors are scared for good reasons. One, the economy is slowing down. The COVID has been very brutal, and their lockdown again has been very surprising. And their policies have been a little inconsistent and not investor friendly. Many tech companies, they came down. So growth slowing down, investor unfriendly policies, means China is something which most investors will be worried about and would not like to put in incremental capital at work. So India becomes a favored destination for investment as well. And then if you look at local growth, so the interest rate hike of say 40 basis point we are done, we might end up with 75. The worst case scenario is 100 basis point. On a 6-7% base, that is not as bad as you go to US on 1.5% if they were to take an increase of 100 basis point. Also, effectively right now, we still don't have negative real rate of interest. That is what is the problem in US and other developed markets. And the macro is doing well. The government policies about providing incentives for manufacturing, the PLI scheme, and many other reforms which government has done, RBI has done, all those are bearing positive results. And so India's macro looks good amidst the global gloom. So what should investors look at? investors should look at a scenario where markets can be very volatile, because when foreigners are forced to sell, many foreign investors that we talk to, they say that they understand that India is very positive and they're extremely bullish on India, but sometimes they face redemptions. They are not able to sell, say, in China or Russia or many other countries. So in the short term, they're forced to sell in India, and that is why we see selling pressure from foreigners. But as soon as they get new money, I think India will be the first emerging market that they will look at investing. So to summarize, markets will be very volatile, that can have corrections. But whenever recovery happens, I think India will be the first one to bounce back. So if you're a long-term investor, stay invested, but don't be leveraged, because markets can be very volatile and you can see sharp corrections there. But from here, if you see 3 years or 5 years, equity markets will still give you very good returns. So if you have patience, don't look at the market, stay invested in good companies. And if you don't have, then obviously market will be very volatile.